Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at CleanSpark.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
I think we have to start with the numbers because honestly, they're so unusual, they almost look like a typo. I mean, we're looking at the Q3 fiscal 2025 results.
And the fundamental strength is? It's really startling. The revenue growth especially.
Right.
It's the kind of growth that just, it makes you sit up and pay attention. The company reported quarterly revenue hitting $198.6 million.
And that's not just a small bump. That's a 91% increase year over year.
Exactly. It's explosive. It shows just incredible operational scale in a market that's just absorbing everything they can produce.
But the real story isn't just the top line, right? It's how they're converting it. They reported a net income of $257.4 million.
Yeah, and that translates to a basic earnings per share, or EPS, of 90 cents.
Which tells you immediately they figured out how to scale without costs just running away from them.
And that efficiency, that story gets even more extreme when you look at the margins. This is where it gets a bit technical, but it's critical.
Okay.
We're looking at an EBITDA margin. That's earnings before interest, taxes, depreciation, and amortization of 217.6%.
Wait. 217%. Most people hear that and think someone hit the multiply button twice by accident. How is that even possible?
That is the perfect question. And it's key to understanding this whole industry. That number reflects the huge amount of capital they spend
on mining equipment, infrastructure, all that stuff.
Exactly. So they have massive depreciation expenses on their books. When you add that depreciation back in, which is what EBITDA does, it just inflates the margin like crazy. It shows you the efficiency of their pure operations before all those non-cash charges.
Okay, so it's not that they're marking up a product by 200%. It's more of an accounting reflection of their business model.
You've got it. It confirms the underlying operation. The cost of power, people, maintenance is incredibly efficient. And the EBIT margin, which is before interest and taxes, backs this up at 116.2%.
So these are figures that signal they can handle the volatility of their sector much better than their peers.
Far better. And that focus on resilience leads us right to the balance sheet. They're sitting on over $3 billion in total assets.
That's a serious foundation, but it's the structure of that foundation, the leverage, that really matters.
The balance sheet is the anchor for this whole thing. They're being so prudent with leverage. Their debt-to-equity ratio is only 0.38.
So for our listeners, that means for every dollar of their own money invested, they've only borrowed 38 cents.
Which is incredibly low. Just signals flexibility and a massive financial cushion.
And their short-term health, their liquidity.
Just as strong. The quick ratio is 3.3 and the current ratio is 4.4.
So in plain English?
In plain English, for every dollar they owe in the short term, they have $3.30 in cash or near cash to cover it. There's almost zero short-term funding risk here. This is their key differentiator.
Okay, so let's use that fortress of a balance sheet to pivot to their strategy, because that money is funding a huge transformation.
A massive one. They are basically redefining the company away from being just a Bitcoin miner.
Right.
We are seeing a really aggressive, really profound pivot into high-growth areas. Think AI, infrastructure, general digital asset hosting.
This is a huge deal. It gives them growth options, revenue streams that aren't tied directly to the crypto cycles.
Exactly. They're becoming a generalized digital infrastructure provider.
And they've put some serious money behind this. That recent convertible note offering wasn't small.
Not at all. They started with a $1 billion offering. It was so popular, it was upsized to $1.15 billion.
So they have a war chest now, strategic dry powder to go out and build this new business.
And it's all designed to rapidly execute on that infrastructure investment and get these AI initiatives off the ground.
Let me play devil's advocate for a second, though. A $1 billion convertible note. That brings execution risk, right? And potential dilution down the line.
It's a high-stakes bet, no question. They chose this route because it gives them better short-term interest rates. And it buys them time to grow into the valuation before that potential conversion hits.
So they're betting the stock will rise enough from this AI move that the dilution won't hurt as much when it happens.
They are betting on it. It's a move of aggressive confidence. And we're already seeing them deploy that cash.
We can see it physically in Texas. This isn't just a PowerPoint slide. They're actually building.
Precisely. The real material pivot is happening in Austin County, Texas. They've got the rights to 271 acres.
Wow.
And more importantly, they've secured power agreements for 285 megawatts. This isn't for more mining. This is for next-gen, large-scale data centers.
So they're taking what they're good at, getting huge amounts of cheap power, and aiming it at the AI and cloud computing boom.
That's the entire strategy.
But if they move into that space, I mean,
Yeah.
like, how do they compete? What's their moat against giants like Amazon or Microsoft?
Their advantage is twofold.
Yeah.
Its speed and its scale, both coming from their existing business.
Okay.
First, their existing infrastructure, that $3 billion in assets, gives them economies of scale right away. They can get equipment and power deals that a startup just can't.
And the second part.
They're already experts in energy management and building these huge facilities, so they're just repurposing that skill set for AI. It lets them deploy much faster than rivals who are stuck just in the crypto world.
That makes a lot of sense. So let's transition. How is the market reacting to all of this? What's the technical picture telling us?
The market has definitely noticed. We saw really bullish price action through late November 2025. The stock was up nearly 10% just in the week before, pushing up towards $19.43.
And what about the bigger picture, the trend over the last few months?
It's the textbook definition of a sustained uptrend. You can see a clear pattern of higher lows and higher highs.
So it's been building for a while.
It has. It pulled back to around $10.65, and it's just been steadily accumulated since. That signals growing confidence from the big players, the institutions.
So for someone listening, what are the key price levels to watch? Where's the floor and where's the potential ceiling?
Okay, so the immediate key support level looks to be firmly set around $16. That's where buyers have been consistently showing up.
And on the upside?
The first hurdle is that psychological $20 mark. If it breaks through that, the path opens up to the next big resistance level, which is around $23.
So a $23 to $24 target and...
Yes, that's a very reasonable target.
What about the standard indicators like moving averages? Are they confirming this trend?
They are. Robust confirmation. Both the 50-day and the 200-day are sloping upwards, and the stock is trading nicely above both. That's exactly what you want to see.
And momentum.
Momentum indicators are healthy, they're showing upward movement, but they're not in that extreme overbought territory yet, which suggests there's still some room to run.
It sounds like the analysts are fully on board with this whole transformation narrative, too.
Overwhelmingly supportive. We've seen major firms recognize the shift. H.C. Wainwright, for example, raised their price target all the way to $30.
Wow.
And if you look at the average analyst target, it's sitting around $23.83. They believe the market is going to start valuing this company differently.
Not as a volatile miner, but as a more stable infrastructure provider.
That's the expectation. A higher valuation multiple.
Okay, so that brings us to the future. What are the big events, the near-term catalysts we should be watching over the next 3 months?
The single most critical event is the Q4 2025 earnings report. We expect that in January 2026. And this isn't just another earnings call.
This is the first big test of the new strategy.
Exactly. Investors will be digging for the first concrete proof that all that capital they raised is actually turning into real revenue and growth in these new business lines.
So they proved they can raise the money. Now they have to prove they can spend it wisely.
And quickly, in the AI sector, beyond earnings, you have to watch the AI execution itself. Any news about partnerships, especially high-profile ones.
And there has been some chatter about that, right? That they might be close to landing a big fish for that new Texas facility.
There is significant speculative chatter, yeah. Talk about a large contract with a major AI or a hyperscale cloud company.
If that happened.
If they announce a binding agreement with a big tech name, that would instantly validate the entire pivot. The stock would likely react very, very quickly.
We also have to keep an eye on just broader market factors, too.
Absolutely. Things like index rebalancing. The Nasdaq 100 review is coming up in December. That can cause big institutional money to move.
And the 13F filings.
Right. The institutional holdings reports. That's where we'll see exactly which hedge funds and big asset managers are buying into this story.
Okay, we have to talk about the risks. Despite the strong balance sheet and the big pivot, nothing is a sure thing, especially in this sector.
Of course, the core risk is still there. This is an industry that is historically exposed to huge swings in crypto prices, regulatory uncertainty. You can't forget that.
So how much does this new strategy really protect them from all that?
Well, the diversification is designed to be the main shield. The move into AI and data centers is meant to create reliable, long-term revenue that's insulated from the day-to-day Bitcoin price swings.
Mm.
And that liquidity we talked about, that's their internal buffer.
But let's circle back to that convertible note for a second. The overall debt is low, which is great. But
Uh,
doesn't that note make them more sensitive to interest rates?
It does. That's the nuance. While the overall debt is prudent, the cost of future capital matters. If rates spike and stay high, it makes things more expensive and puts more pressure on them to hit those growth targets.
So it's a calculated risk.
It's a calculated risk. They're trading that pressure for much cheaper funding right now, which they need for this massive build-out.
So if we synthesize everything, the explosive growth, the wild margins, the fortress balance sheet, this huge capital deployment, and the high-stakes pivot to AI in Texas, what's the final narrative here?
The synthesis is that this story is no longer about just being a slightly better miner. It's driven by bold capital deployment and these massive infrastructure commitments. The AI focus is everything. It should drive a significant expansion of their multiple. They're shedding their old identity and attracting a totally new class of investor.
It's a fascinating shift. And the company has already hit incredible scale. They're over 50 exahash per second of self-operated capacity. That's just a mind-boggling amount of computing power. They've kept their leadership stable through all this. So the question isn't if they can execute anymore, it's who will validate it. The capacity is being built. The next big thing the market is waiting for is to see which major AI partner validates all that new data center space with a big public contract. That's the announcement that could change everything. Make sure you subscribe to Smart Wealth with Joshua for ongoing analysis as this critical story unfolds.